Ready to stop treating the stock market like a casino? Great, because today, we're not chasing fleeting trends, we are planting seeds in fertile ground. We're uncovering two businesses that are not just growing, but actively winning the future in massive, multi-billion-dollar industries. These are the brilliant growth stocks you buy, forget about, and let wealth build over the next decade. Hit the like button, share the video and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Let's get to it. Growth stock number 1 is Roku, ticker symbol ROKU, the advertising machine. The first powerhouse we need to talk about is the undisputed king of the living room in North America. We are, of course, talking about Roku. As a long-term investor, you must understand this fundamental truth. Roku is not a hardware company. It is a high-margin digital advertising and operating system platform. They figured out early on that by giving away the razor, the devices and TVs, they could sell the razor blade, the high-margin ad inventory and platform access. Roku now boasts tens of millions of active accounts and billions of hours of streaming every quarter. This scale provides a massive, high-quality and highly engaged audience. In the advertising world, this is gold, as the $70 billion TV ad market in the United States shifts from traditional linear TV to streaming. Roku is uniquely positioned to capture that budget. Why? Because they are the gatekeeper. They sit between the streaming services and the consumer. This crucial position allows them to execute what they call Roku advertising. It offers advertisers precise targeting capabilities that linear TV simply cannot match. They can tell exactly who is watching, for how long, and what they are watching, delivering personalized ads that lead to much higher monetization per user. Crucially, their push into original content and own channels, specifically the Roku channel, is a margin expander. By owning this popular ad-supported content, they maximize the percentage of ad revenue they keep. This strategy also enhances their valuable first-party user data, creating a powerful flywheel effect. More users mean more data. More data means better ads. Better ads mean more revenue, and more revenue fuels growth and investment in better products. Looking ahead, the long-term runway is defined by two key factors: increasing average revenue per user, or ARPU, and international expansion. Even with their domestic dominance, there is still significant room to increase the ad load and rates. Simultaneously, their expansion into markets like Mexico, Canada, and various European countries represents a huge, untapped pool of potential users ready for the streaming transition. Roku today sits as a sizable media platform play with a market capitalization of $15.11 billion. That's $15.11 billion. But the economics still show strain. Last year, Roku reported revenue of $4.11 billion in 2024, and on the profit line it posted a net loss of about $129,380,000, a negative $129.38 million. Earnings per share came in at negative 19 cents, or minus 0.19 per share, which tells you that while the top line is meaningful, profitability remains an ongoing challenge as the company balances content, platform investment, and advertising monetization. This combination of platform scale, data advantage, and relentless monetization focus makes Roku an essential pillar for any long-term growth portfolio. This video is brought to you by the Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Don't rely on luck or hot tips. Learn the proven systems professional investors use. Click the link in the description and pinned comments to get the course today, and take control of your financial future. Growth stock number 2. Exact Sciences, ticker symbol EXAS, the precision oncology leader. Our second brilliant growth stock is a company making enormous strides in one of the most important sectors in the world, healthcare. This is a stock that truly offers both growth and a profound human impact. Exact Sciences. The core of their investment thesis starts with their flagship product Cologuard. It's a non-invasive, stool-based DNA test for colorectal cancer screening. Colorectal cancer is the second leading cause of cancer death, yet it is highly curable when caught early. Cologuard addresses the main hurdle in screening, patient reluctance, by making the test simple, non-invasive, and done at home. This simplicity translates into higher compliance rates, and, higher compliance equals saved lives and booming revenue for Exact Sciences. The sheer size of their market is staggering. The addressable market for colorectal cancer screening alone is in the billions, and even with Cologuard's success, market penetration is still relatively low. This leaves a vast immediate runway for their high-margin screening revenue to grow, driven by two vectors. First, attracting the millions of people who refuse traditional colonoscopies, and second, capturing the recurring revenue stream as health plans and providers encourage patients to retest every 3 years. EXAS Sciences trades at roughly $12.53 billion in market value, $12.53 billion, and generated $2.75 billion of revenue in 2024. But that revenue hasn't translated to profit. EXAS Sciences posted a net loss of about $1.02 billion, negative $1.02 billion, and its earnings per share were deeply negative at minus $5.35, or $5.35. Put simply, EXAS Sciences is operating with a much wider per-share loss profile than Roku, reflecting heavy R&D, commercialization costs, and margin pressure in the diagnostics business. With improving financial metrics, a powerful commercial channel, market-leading products, and a pipeline poised for generational breakthroughs, EXAS Sciences offers a compelling mix of growth, technological dominance, and high societal value, making it a powerful long-term anchor for any growth portfolio. So, there you have it. Roku, the ad tech platform dominating streaming, and EXAS Sciences, the medical pioneer saving lives with early detection. Both companies represent high growth potential driven by industry-leading positions and a clear path to expanding profitability. So, what does this mean for investors watching? Roku shows a platform company with solid revenue scale but lingering profitability questions. The growth is there, the margins are not yet. EXAS Sciences shows meaningful revenue from its diagnostics franchise but also very large losses per share, signaling a tougher path to earnings unless costs come down or revenue ramps faster. Both names are sizable, both are losing money on the bottom line, but the drivers are different. Roku's challenge is translating scale into stable margins. EXAS' challenge is turning clinical and commercialization investment into sustainable profitability. I want to know what you think. Given the rise of competition from other streaming providers, what do you believe is Roku's single most important competitive advantage right now? Their massive installed base or their aggressive move into ad tech? Let me know in the comments below. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members there get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Don't forget to like, share your thoughts in the comments, and subscribe to the YouTube channel so you don't miss out on the next important financial investing update. Thanks for watching, and I'll see you in the next one.